Two legendary market experts are stepping forward to warn we're in the earliest stages of what they call the Great Unraveling, a specific event starting to take root in America that's behind the recent crash in stocks and the record inflation you're seeing. But they worry it's about to get even worse. And many of the things you take for granted are due for a big disruption in the months ahead. Your Social Security benefits will likely be slashed. Your taxes are probably going way up. And many of your investments are likely to continue falling. Meanwhile, even if you think you've saved enough money to retire, you're probably going to need way more money than you thought. Your personal success all comes down to how well you understand what's heading your way. This is why I strongly encourage you to read about their warning today, totally free. It's all spelled out in a free report we've put together about the Great Unraveling. Get the facts yourself. Go to unravelingreport.com to get your free copy of this report. You can learn how to get their full playbook to prepare for what's coming. Again, that's unravelingreport.com for a free copy of this new report. Hi, this is Daniela Cambone, and welcome back to the Daniela Cambone Show and the launch of our Outlook 2023 series, Powershift. Joining me today is best-selling author, and he's back with a brand new book that's already getting 5-star reviews. And now his latest, Sold Out, How Broken Supply Chains, Surging Inflation, and Political Instability Will Sink the Global Economy, fits in perfectly with our Outlook theme, Powershift. Welcome back, Jim. Nice to see you.
Thank you, Danielle. Great to be with you. And you're right. You know, the book is just out now, and but it has a lot of forward-leaning predictions in it. So the fact that you're doing a 2023 forecast show is perfect timing, because that is a lot of the book. It does exactly that.
And I always love having you on for our Outlook series, Jim, so you could, prepare us for the landscape ahead in the new year. Like I said, our theme this year is Powershift, because I really felt we are, at the cusp of a change in power here. We see the rise in the power of the BRICS. We see, question marks surrounding, will the U.S. dollar remain the reserve currency of the world? But we're going to get to all that. First, I want to talk about Sold Out. Like I said, it's already getting, 5-star reviews here. Tell us a little bit about what we could expect in the book here.
Sure. This book really evolved this time last year, around November 2021. You'll recall there were headlines, bare shelves, empty shelves, supply chain breakdown, Christmas will be canceled, etc. And it was all true. You went to the supermarket. It didn't mean that every shelf was completely bare, like East Germany in the 1950s. But there were, paper goods might not be there, or maybe your favorite kind of tomato sauce, or chicken, or whatever it was. There were some things there, but a lot of things weren't there, and that got worse. And then, of course, gas prices skyrocketed because of basically because of a lot of bad policy from the United States in terms of Keystone Pipeline and a lot of other factors. That then got worse. It eased up a little bit in the summer, but it never went away. This is a complex system. It was breaking down. That was very clear. And now we're seeing a second wave of that. And I point to, one, I don't want to overuse metaphors, but one metaphor is you have a very beautiful, expensive vase, and somebody knocks it over and it breaks into 5,000 pieces. You can't put the vase back together. You've got to go get a new one. And that's what's happened with the supply chain. What I call supply chain 1.0 from 1989 to 2019 is broken. There will be a new supply chain. There always are. Supply chains have been around since the Bronze Age, if not earlier. But the new supply chain, what I call supply chain 2.0, will look very different than the old supply chain. Right now, we're in an in-between period where things don't work well. Again, it doesn't mean total chaos, but you still see shortages. You still see higher prices, which are coming from supply chain disruptions. And these things are not easy to fix, but they can be replaced, and that's what I expect to happen.
Tell us a little bit about what the new supply chain looks like. I'm curious. What like the source you mean is different? The country where the supply chain?
Exactly, both of those things and more. So what happened in between 1989 and 2019? Well, beginning in '89, you had the fall of the Berlin Wall. 1991, the demise of the Soviet Union. 1992, Deng Xiaoping's Southern Tour, which is when China really came into the global economy. Yeah, they had some good growth in the 80s, but the Tiananmen Square set them back, and then there was a hiatus, and then 1992 they came back on stream. So all of a sudden, it wasn't just international trading, which I had studied and worked in the 60s and 70s and even the 80s. This was true globalization, which grew in the 1990s. So all of a sudden, your supply chains went from Chongqing to New York, or from Shanghai to Amsterdam. These are 9,000, 10,000 mile supply chains. And the more you stretch the supply chain, the more things that can go wrong. Now, why did everyone do this? And also, there was, around that time, increased computing power, artificial intelligence, better applied mathematics, and more data gathering created supply chain science. I make the point, supply chain has been around since the Bronze Age, but supply chain science was relatively new. It was all driven by efficiency. Lower costs, lower costs, lower costs, kind of the Walmart model. And it worked. Either lower costs mean either bigger margins for producers or lower costs for customers, or both. And it worked. But there were hidden costs in the process. And the hidden costs were, when you stretch things that far and have that many inputs and that many things that can go wrong, you've created a very fragile system. And now we're seeing the hidden costs come to light to break down. So what does the new supply chain look like? A couple of things. I see the creation of what I call a college of nations, basically a group of like-minded countries that will continue to trade with each other, will rely on each other for outsourcing, but it won't be everybody. It'll be like a club, and it'll be the liberal, democratic, good rule of law societies that respect human rights. So United States, Canada, Australia, Japan, New Zealand, Western Europe, and then there'll be some other countries that will be in the club. India, Brazil, and a few others. And they'll trade with each other and build factories in each other's countries. So you'll still have supply chains, but it'll be much more compact. China will be completely decoupled. And by the way, that's a mutual view. The U.S. is decoupling from China, but China wants to decouple from the United States just as badly. So China's going to be out of this college of nations, as I describe it. They're going to have to form their own club. So what you're going to end up with is, will countries trade with each other? Yes. But it'll look more like the 1950s and 1960s, where you have like-minded countries. You're either in the club or not in the club, but the U.S. and China are going to be running two different clubs, because that has implications for economic growth, currencies, direct foreign investment, and so forth. But it's going to evolve that way. It's happening already.
Is there any core, link as to why we see the shutdowns in China again? Obviously, pressure on the economy again. Is there any link there as to, let's wreck the economy to get onto this new model supply chain?
I think both policies are intentional. I wouldn't say they're using COVID to wreck the economy to decouple from the United States. Xi Jinping wants to decouple anyway. And let me just give you a counter example. So Taiwan Semiconductor Manufacturing Corporation in Taiwan is the world's largest and most sophisticated, most advanced semiconductor manufacturer in the world. They have announced in recent months that they're building 2 plants in Arizona, over $10 billion each. These plants take 5 years to build. They're very, very challenging to build semiconductor fabrication, so-called fabs. So why is Taiwan Semiconductor putting $20 billion to build 2 fabs in Arizona? Why not build them in Taiwan? Why not build them in China, for that matter, where there are certain advantages? Well, the answer is they're looking at the world ahead. They see a potential invasion of Taiwan by China. And the U.S. military has a theory, what we call the broken nest theory. And it actually comes from a Chinese proverb, ironically. It says, if the nest is broken, how can the eggs be intact? And of course, the answer is they can't. So if China invades Taiwan, the first thing that's going to happen, either the Taiwanese or the United States are going to destroy Taiwan Semiconductor's plants. We're not going to let China take over Taiwan and have all that technology. We're going to just burn those plants to the ground, basically. And Taiwan Semiconductor knows that. So, okay, we'll build in the United States and keep our company going. That's an example of, you can call it onshoring. Janet Yellen calls it friendshoring. There are other names for it, but that's an example of this college of nations being willing to trade with each other and not rely on extended supply chains to China.
Let me ask you this then, Jim. Is that not a benefit to the U.S., Canada, Western, Europe, Australia, et cetera, that there, if this model does come to fruition, that there is no longer this reliance and dependency on China?
Absolutely, and it's a great question. When I get to the end of the book, I do talk about winners and losers. I'm very critical of a lot of public policy and a lot of what's going on. I describe it in detail, but I don't like to do that without offering, forecasts and solutions and so forth. And you're right, one of the big winners out of this is going to be the United States, and I would put Canada in the same camp, because these are high-paying jobs. I mean, people work in, in semiconductor factories. They're, not everybody has a PhD, but you need some training, you need some skills. Those are, whether they're union jobs or not, they're high-paying jobs with benefits. They're going to be coming home to the United States, and they're going to be lost to a place like China. Now, China's vowed to build up their own semiconductor industry, but they don't have the technology. They can make kind of 10 nanometer, 15 nanometer chips, but they can't make the 3 and 5 nanometer chips that Taiwan Semiconductor can make. So I do go through winners and losers, and you're right. I think the U.S., because the U.S. has the technology and the workforce and an educated workforce and so forth, it'll be one of the winners. But I also see India as being one of the big winners in this as well.
I want to hone in on the part of your headline here for the book, the title, Surging Inflation, because I know the comment section will be like, well, remember Jim thought we were at peak inflation. And before people make those comments, we addressed this in past interviews with Jim. He made the case for that. So please watch the previous interviews. I'm not going to discuss that today. I want to know where you are at now when you say surging inflation not going away anytime soon. Are the Fed moves not working, Jim?
We are at peak inflation. Inflation is going away very quickly, and the Fed moves are working now. It doesn't mean that the Fed won't blunder and make this worse. I think they will. We can come back to that. But, okay, so the inflation sort of came on the scene in mid-2021, in the summer 2021. By the fall, it was very high, and this is when Jay Powell was saying transitory, transitory, transitory. By November 2021, he threw in the towel. He said, okay, time to retire the word transitory. And then they started hiking rates in March. On March 1st, the policy rate, the Fed funds target rate, was 0. Today, it's 4.25%. It's going to go up another 50 basis points on December 14th. So, and then the next meeting after that is February 1st. So they're going to keep raising over 5, probably get to 5.25%. That's in less than a year. I mean, we've gone to 4.25 in less than 8 months, or just barely 8 months. So, but inflation is already off the top. It's going to come down a lot more. The markets are not ready for that. I see the inflation. I put gas in my car. I go to the grocery store. I see it just like everybody else. Home heating costs, and eggs, milk, bacon, food, gasoline, etc. But here's the point, Danielle. There are two major sources of inflation potentially. One is the supply side. So supply shortages, supply chain disruptions, the kind of things we've been talking about. That's called cost push inflation. Costs go up and it gets pushed onto the consumer. The other source is demand, what's called demand pull inflation, which is more psychological. Consumers are thinking about choices and they say, I was thinking about buying a refrigerator. I was going to wait 6 months, but hey, the price is going up. I better go buy it now before the price goes up. In the 1970s, we had both. We started with cost push from the Arab oil embargo, but it flipped into demand pull in the late 70s, and it just spun out of control, and Paul Volcker had to crush it. Today, the inflation is coming from the supply side. Some of the things we talked about, higher fuel costs. I mean, everything has to be transported, so fuel is part of everything. It gets built into the price of everything. And there are other shortages and bottlenecks and costs that have to be taken up by manufacturers and distributors. So that's real. I'm not saying the inflation isn't real, but it hasn't leached over onto the demand side. The psychology of consumers is not, gee, I better buy it today because the price is going to go up. It's like, no, I better save money today or watch my budget, etc. And here's the difference. Demand pull inflation feeds on itself. The more of it you get, the more of it you get. It does spin out of control. So the cost push inflation from the supply side tends to be self-negating. There's an old saying, the cure for high oil prices is high oil prices. If your SUV or Ford F-150 pickup truck, if you're filling up the tank, went from $75 to $150, which it has, that demand is inelastic. You got to put gas in your car. You got to get to work, take the kids to school, whatever it may be. But that means $75 in my example that you're not going to spend on dinner or a concert ticket or a vacation or a new dress or a new suit of clothes or whatever it may be. So that tends to, and so here's the Fed trying to deal with inflation, but they're dealing with it from the supply side. The Fed doesn't drill for oil. They don't drive trucks. They don't grow crops. They don't have farms, etc. The Fed can't do anything about supply side inflation except destroy demand. But here's the question. How much demand do you have to destroy to control inflation coming from the supply side? The answer is a lot. They're trying to get to a terminal rate. They're already there. They just don't know it. They'll be the last to know. So they're going to take rates to 5.25 or higher by March. But they're already at the terminal rate. They just don't know it. And so inflation is already coming down. And this is the thing that the markets and investors are not ready for. Inflation is going to come down fast. There's even some danger of deflation and a major U.S. recession in 2023. And no one's ready for that. I mean, people talk about recession, but it's going to be worse than they think.
And then they ramp up the printing press again, Jim.
Yes, but it doesn't work. And we've seen this movie. $9 trillion of QE didn't do any good. I mean, how does the Fed do QE? They buy bonds from banks, give the money to the banks, and the banks give it back to the Fed as excess reserves. What does that do for the economy? Nothing. Zero rates, again, it doesn't work. They don't have the tools.
I want to bring up this article from Bloomberg. There's a hidden risk to the global financial system embedded in the $65 trillion of dollar debt being held by non-U.S. institutions via currency derivatives. This is according to the Bank for International Settlements. The article goes on to say a lack of information is making it harder for policymakers to anticipate the next financial crisis.
Well, first of all, that article is exactly right. We've been talking about recession, inflation, deflation, but the one thing we haven't spoken about yet, you kind of just referred to it, is there a global liquidity crisis coming? And a liquidity financial crisis is different from a recession. Sometimes you can have one without the other. In 1990 we had a recession, there was no crisis. 1998 we had a crisis, there was no recession. The economy was fine in 1998, but the financial world almost came to an end. Sometimes they come together, and that's what happened in 2008. We may be looking at a scenario like that. By the way, 65 trillion in foreign currency derivatives, yeah, but try 1 quadrillion in total derivatives. I mean, that's foreign currency, and that was the focus of the BIS paper. But when you get into interest rate swaps and commodity swaps and swaptions and all the rest, that's 1 quadrillion, which, for people not familiar with the Q word, is 1,000 trillion. So you pointed to 65 trillion, and you're right, that's FX, but there's 1,000 trillion or 1 quadrillion of derivatives off balance sheet of the banking system, supported by collateral, a little sliver of collateral, and there's a dollar shortage, and that's getting ready to implode.
So, we're not painting a rosy picture here, obviously, with all these moving pieces and question marks and whatnot. The global outlook is pretty gloom and doom, Jim, but I like that in your book you offer solutions, or how can we get ahead. So let's talk a little bit about this, of how we as an investor get ahead, prepare ourselves for what's ahead here.
Well, a couple things you can do. One thing, I would increase my cash allocation. A lot of people hate cash. They're like, it doesn't have any yield. Why would I do that? I'm missing out on whatever, Bitcoin or stocks or whatever. Cash is extremely valuable. Number one, it performs very well in disinflation and deflation. Deflation, it could be even with a very low nominal yield, it can have a much higher real yield in a world where prices are going down. So it's a good deflation hedge. But more importantly, cash gives you optionality. If taking everything we just described about a potential stock market crash that could be 30% or more, a global liquidity crisis that could be worse in 2008. I mean, there are plenty of signs of both of those things. Well, if you're the one with cash, first of all, you're not going to lose money on cash. You will on stocks and other asset classes, but not cash. And then when this drawdown comes, when this collapse comes, you're the one who can go shopping. You can go out in the wreckage and say, oh, well, here's a good company. It's down 90%. I'll buy some of that. By the way, the person with the most cash in the world is Warren Buffett. Berkshire Hathaway has over $130 billion of cash. Now, why do they have that? The answer is Buffett sees the same thing I see, the same thing we're talking about right now, which is in a highly uncertain world with a lot of vulnerabilities, that's exactly what we're describing, that come home to roost, and that's how I see 2023. Cash will preserve wealth and then give you the opportunity to pick up bargains. I'd also have a slice of gold. I recommend 10%. People always want to put words in your mouth. They go, Jim Rickards says, sell everything and buy gold. I've never said that. I don't think it's a good strategy. 10%, yes. Now, if you have 10%, sit tight. It'll serve you well. If you don't, you might want to get some gold, because a lot of what we're talking about is going to play out in foreign exchange markets.
I want to just bring up crypto here, since we've spoken about it in the past. Obviously, a horrific year for the sector. Do you think that Bitcoin will still be around, Jim?
Eventually, no. It'll be around for a while, and it might, outperform some of the other cryptos. But I'm struck by the fact that I go back to the Gertzer-Stein theory. There's no there. And what's interesting about the last 5 years, and by the way, I say things like this, Danielle, and people go, "Oh, Jim Rickards, he's a dinosaur. He doesn't understand technology." It's a nonsense. I read, Satoshi Nakamoto's paper within months of its coming out. I've been in, gold, Bitcoin debates since 2010. I actually know a lot about it, which kind of brings me to my point, which is with nothing in the center, they replicated the entire structure of Wall Street. So you have exchanges, custodians, futures, options, settlement, clearance, lending, yields, etc. This whole Wall Street infrastructure, financial infrastructure, around nothing. I mean, Tesla stock, for example, maybe you like Tesla, maybe you don't. That's an individual choice. But at least they make cars. There's a real car there. And even intangibles, insurance companies provide services. There's something there. In crypto, there's nothing there. But they've replicated this infrastructure. And so a lot of the wealth that's been generated in crypto is because you own a crypto exchange, or you own a lender set. Now, that's all imploding. It's kind of a replay of 2008, except instead of, Bear Stearns, Lehman Brothers, Fannie Mae, Freddie Mac, and, Morgan Stanley was hanging by a thread. It's, FTX most prominently, but Genesis is kind of considering bankruptcy, et cetera. So all that is collapsing. So Bitcoin's not an exchange. It's not part of that infrastructure. It's just a coin. The best analogy I've been able to come up with, Danielle, I mean, I have a lot more to say about it coming out of communications theory, but it's like a casino chip. If I walk into a casino and put my money on the roulette table and the croupier gives me chips, I can gamble them, I can play with them, I can make money or lose money, but when I leave, I go to the cashier and get my dollars back and walk out. If I take the chips outside the casino, they're worthless. I can't pay for dinner with casino chips. So cryptocurrencies are casino chips. You're in the crypto casino. Some people made a lot of money, and I know some of them personally. A lot of people have lost a lot of money. More have lost than made money, which is how casinos work, by the way. So eventually they'll all go to zero, but in stages. But what's collapsing right now is the infrastructure.
I know you have to run, but I'm going to try and get another point here, because it's been a while since we last spoke, and since that time, we have new numbers regarding how much gold central banks are buying, 400 tons in Q3 this year, records and numbers we haven't seen since the 80s. Yet we don't know some of those mystery buyers. Obviously, the theories are that they are Russia and China. I'm curious to get your thoughts on central bank record buying of gold here, and how Russia and China fit into this puzzle here.
It's a great question, and we have the data. Now, China's non-transparent. Russia is much more transparent, although Russia is starting to be opaque a little bit because they're in a war. But you can see the inflection point is 2010. So from 1970 to 2010, it's a long stretch, 40 years, central banks were net sellers. It didn't mean everybody sold everything, but Switzerland's down 1,000 tons, U.S. was down 1,000 tons after losing 8,000 tons, or sorry, 11,000 tons between 1950 and 1970. It was down, down, down. 2010 was the year that central banks became net buyers. Now, it doesn't mean every central bank was buying gold. It does mean that they were selling a lot less and others were buying more. And some of the buyers are Mexico, Kazakhstan, Philippines, Vietnam. We know China's a big buyer. We don't know exactly how much. Russia was a big buyer. That is continuing. Now the new players, Iran's non-transparent, but we know they're buying gold. Turkey is buying a lot of gold. Japan had a bunch of gold all along. They never told anybody about. Literally in 1 month, their reserves went from 600 tons to 900 tons. Well, you know the market. You can't buy 300 tons in a month, not one country in one order. But they had it all along, but they decided to reveal it, put it on their balance sheet. So Americans don't seem to like gold. I'm not sure Canadians feel much differently, or others around the world. But central banks sure do, and I think that tells you something.
Exactly. It absolutely does tell us something. What are they preparing for, Jim?
they're preparing for what we're talking about, which is a world where the dollar as a reserve currency will not be deposed overnight. But as a payment currency, there's a difference between a reserve currency and a payment currency.
Right.
Anything can be a payment currency. If I want to pay you with baseball cards and bottle caps and you're okay with that, then it's a currency. So when we see the BRICS Plus, the Shanghai Cooperation Organization, OPEC Plus, China individually, all these countries are the Eurasian European Economic Union, which is Putin's answer to the EU. All of these organizations are working on new payment systems right now, and they're going to start to roll them out this year and later. So that's going to be a radical change in how we pay for things.
And I think that's such an important point you made, Jim, and thank you for that, because you're saying its status as a reserve currency is a completely different discussion. You're saying that's not going to go away overnight.
Right. Yeah, it took 30 years for sterling to be run off the road. It started in 1914. And with World War I, it was completed in 1944 with Bretton Woods. So that the dollar did displace sterling, but it took 30 years. The thing is, people don't understand reserve currency. It's not as if the People's Bank of China has pallets of $100 bills stacked up in the basement. Reserve currency means a currency of denomination of securities. So what China does have are treasury bills and treasury notes. So the key to being reserve currency is not the currency, it's the bond market. Do you have a large, safe, liquid bond market? And if you do, then people will buy those bonds. What else are they going to do with the money? But that's much harder to replicate.
But if China is stockpiling, hoarding gold, not telling the numbers, are they planning to release some sort of a currency backed by gold? What do they want to do with it?
Well, they can't have a currency backed by gold, at least not the Chinese yuan, because the problem is there is no Chinese yuan bond market of any size, number one. Number two, they have no rule of law. I mean, no, I wouldn't trust the Chinese or the Russians for that matter. And the U.S., the problem with the U.S. is that we had a good thing going. I've always said the world will not destroy the dollar. The United States will destroy the dollar through our own policy blunders. And when you freeze the assets of the Central Bank of Russia, I don't want to debate the war in Ukraine, that's a big subject, but when we freeze the assets of the Central Bank in Russia, and you're the Central Bank of Turkey, Saudi Arabia, China, you're like, hey, how do I know that next week the U.S. isn't going to not like something I did? Are they going to freeze my assets?
Right.
So little by little, yeah, at the margin, you get out of treasury notes, you get out of euros for that matter, and get into gold. So there is this displacement effect going on, and it wouldn't surprise me to see China announce a big bump, maybe 500 tons or more in their gold reserve. I would say they already have it; they just haven't announced it.
Jim, I know you got to run, but I appreciate your insights today. I was really curious to get your thoughts on many of those talking points. So thank you.
Thank you. Great to be with you again.
And I urge everyone to get a copy of Sold Out. Will make a great Christmas stocking stuffer gift. Run out, get your copy. And Jim, best of luck, continued success with the new book. And Merry Christmas to you.
Merry Christmas, Danielle, you and your family.
Thank you. And thank you all for watching. The start of our Outlook series is we're just getting going here with great guests like Jim Rickards, and we'll have more in store for you. So be sure to sign up at danielacambone.com so you can stay on top of it all. That's it for me today. Thank you for watching.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.